let's talk about something that's probably on your mind, especially if you remember 2008. Financial security. Look, it's totally understandable to be a little skeptical of complex financial strategies, but what if I told you that one of them, premium financing, actually has some incredible layers of stability built right into its DNA? We're going to break down exactly how that works. This right here is the question that really matters. The 2008 financial crisis, that was the ultimate stress test for pretty much everything. So when we look at any strategy today, we have to ask, how would it have held up in that absolute worst case scenario? What happens when the whole system is pushed to the brink? And this is our starting point, this single, powerful fact. This comes from industry analysis done right after the crisis. Think about that. While some of the biggest banks in the world were failing, the fundamental promise of the insurance industry, it held strong. This is the bedrock we're going to build on as we tackle the big what-ifs one by one. All right, so let's jump into the first major concern. This strategy uses a loan from a bank. So what happens if that bank goes under? It's a totally fair question. Let's walk through exactly how the system is designed to handle this. Now, this requires a little shift in how you think about a loan. To you, a loan is a debt, right? It's a liability. But to the bank, it's the exact opposite. Your loan is an asset on their books. It's a good performing asset. And when a bank fails, you don't just throw valuable assets in the trash. They're carefully managed and they're sold. Your loan is one of those valuable assets. So here's the key takeaway. There is an orderly, regulated process for this. It's not chaos. A regulator like the FDIC comes in and your loan gets sold to another healthy bank. And for you, honestly, almost nothing changes. The terms of your contract, your payments, they all continue exactly as they were. The system is built for this exact kind of continuity. Okay, so we've established the lender side is secure. But what about the other piece of the puzzle? What happens if the actual life insurance company gets into financial trouble? This is where another incredibly powerful state-level safety net clicks into place. Every single state has something called a guarantee association. The best way to think about it is like an insurance policy for your insurance policy. And get this, it's not funded by taxpayers. It's funded by all the other healthy insurance companies. It is a legally required backstop designed for one reason, to protect you, the policyholder. And here's exactly how that safety net works. If an insurer fails, this very structured process kicks off. The Guarantee Association jumps into action, and its number one goal is making sure you don't lose your coverage. The most common outcome, by a long shot, is that your exact policy just gets moved over to a new, healthy insurance company. The whole thing is designed to be as seamless as possible for you. Now, in the very rare case a policy can't be transferred, the association pays benefits directly. And these aren't just vague promises. They're backed by specific legal limits. So, for example, you typically have up to $300,000 in protection for the death benefit and $100,000 for the cash value. This gives you a really powerful and tangible baseline of security. So we've covered these huge systemic failures, which are incredibly rare. But what about something more common, like a bumpy market? This is where we pivot from risks you're protected from to risks that you, with the right person in your corner, can actually manage. I know the term margin call can sound pretty scary, but let's just pull the curtain back on it. All it is a notice from your lender. It happens if the value of your collateral, the cash value in your policy or other assets, dips below a certain level that's in your loan agreement. It's not a sign of failure, it's just a signal that it's time to rebalance things. And here's the most important thing to remember. You have options. A margin call is not the end of the road. It's the start of a conversation. You could add some more collateral, pay down a bit of the loan, or even restructure things within the policy. Lenders want to find a solution that works. They're not looking to pull the rug out from under you. They'll typically give you a 30-day window to work together on a plan. So how do you juggle all these moving parts? The lender, the insurer, the market, it's a lot to keep an eye on. And that's exactly why you should never try to navigate a complex strategy like this all by yourself. You really need a guide who is legally and ethically bound to have your back. And that guide is called a fiduciary. This is such an important word. A fiduciary isn't just any advisor. They are a professional with a legal and ethical duty to put your interests first. Period. Always. Their advice has to be completely free from conflicts of interest, and that is the absolute highest standard of care you can get in the financial world. At the end of the day, a fiduciary relationship is all about a promise. It's a legal and professional commitment to put your financial well-being ahead of everything else. It means having a true expert in your corner who is 100% dedicated to your success. So you see, finding that right expert, a true fiduciary, it isn't just a nice idea. It's really the most critical piece of this entire puzzle. It's what transforms a complex strategy into a confident plan, because you have a trusted partner for your whole financial journey. And that is why I'd like to introduce you to Avi Crane. He's a financial fiduciary and an investment advisor representative with Alpha Innovation Partners and Infinity Financial Services. He specializes in guiding people through these exact kinds of strategies, all with that high standard of care we've been talking about. So instead of just wondering if a strategy like premium financing could work for you, why not take the next step? Talk to an expert who is legally bound to put your interests first. Here's all of Avi's direct contact information. Reaching out to a fiduciary is absolutely the smartest way to find out if this is the right move for your specific financial goals.